If you have been struggling on how to determine the market bias of the day, whether to go long or to go short, or sometimes if you go long and you feel like it instantly reverses and goes down, or when you short and it instantly goes up and squeeze you out, then this video is for you because I will share with you one secret and often overlooked indicator that helps you determine the market bias, and generally speaking, it has a 90% win rate on the long term. You might have heard of this indicator before, and it's not actually an indicator you can put on your chart. What I'm referring to is the VIX, also known as the Volatility Index. If you want to find it, go to your broker and type in VIX and you'll have the Volatility Index. You might have heard of VIX before, but many people don't know how to use it properly. First, let's talk about the broad strokes. Generally speaking, the VIX measures the volatility of the current market condition. Most of the time, when the VIX goes up, the market goes down. As you can see VIX here, during the trade war in April, this is April the 4th. As you can see, the market had a big tank because of the trade war right here, while the VIX is popping up. When the VIX goes up, the market goes down. On the contrary, when the VIX goes down, the market goes up. If you look at this day, April the 9th, this is the infamous day when Trump says, "I'm doing a 90-day pause on all the tariffs, and right now is the best time to buy." And when he said that, the market rallied 2,000 points on NQ, and on this day, the triple Qs went from 493 to approximately 548. A super insane move. While the VIX was getting crushed, the market was going up. Now at this point, you may be thinking, oh, this is so simple. All I gotta do is to buy the market when the VIX goes down and short the market when the VIX goes up. But if trading was this easy, everybody would be a millionaire by now, isn't that true? One thing you have to realize is that the VIX and the market sometimes are not always inversely correlated, meaning when one goes up, the other goes down. For example, today, the VIX was actually on a daily breakout. As you can see here, it went from 1498 and popping into the 1570s. However, the market today could not sell to the downside. One of the reasons is because the market is on a blue sky breakout. So sometimes, even when the VIX is popping higher, shorting a blue sky breakout is not an easy thing to do. If you traded with us today on the live stream, you would have recognized that as a natural bull, I could not engage in too many longs today in the morning and in the early afternoon. I only started doing more longs later in the afternoon because I recognized that the market is holding it up despite the fact that VIX is going higher. And this is what many people don't understand. You cannot blindly look at an indicator, which the VIX is not really an indicator, but I call it an indicator because it indicates where the market could possibly go. Nothing is 100% certain. When the VIX is going up and the market is also going up, then you can do either of two things. Number one, you cannot do anything. You don't have to trade. You don't have to click a button. Many people feel like they have to click a button, and so they take a loss and blow up their accounts. Most people don't understand that when the market condition is risky, meaning that if the VIX is telling us it is possible that a sell is going to come in the market and it's not happening today just yet, you don't go and push full port short. In fact, this morning, I had 2 accounts red and 2 green trying to short the market, but I stayed in the game. This is a very important concept that you must learn, and that is called staying in the game. When the market doesn't go the direction that you expect it to go, and you find it risky to go long, you don't have to go long. You can just not do anything. On a day like today, many people will keep shorting, thinking that the market has to reject, and it doesn't reject today. They blow up all their accounts because they try to full port, add, and blow up all their accounts only to have the market 2 days, 3 days, 4 days later have a massive sell to the downside, and by then they have no more capital, they have no more accounts because they tilted and blew up on a day when the market didn't do it on their timing. Another important factor you need to take note is when you look at the chart of the VIX, you'll see that many times there's a pop and then there's a crush. It's called the VIX crush. When it pops, eventually gets crushed. Even during the COVID lows, it did the exact same thing. This was the August VIX push into the 65s, then it got crushed and the market rebounded. And so how do you properly use the VIX other than knowing that when it goes up, the market goes down? What you can do is you can anticipate the move that the VIX is about to happen. For example, if you see that the VIX has been crushed over and over again into lower lows, then you don't want to push the gas on buying the market because we will have a pop like this. Conversely, when you start seeing that there are 2 straight up days on the VIX like that, you also don't want to be full port short in the market because when the VIX get crushed, the market is going to rebound. And if you pair the seasonality of the market, such as September and November possibly being one of the worst months in the market, and you see that the VIX is starting to look like it's going to have a daily breakout to the upside, then is it the smartest move to go and try to full port and buy the market at the highs? That is a question you'll have to answer yourself. Generally speaking, if you are more of a long-term investor or if you're a swing trader, the VIX is a really good tool to gauge when is a good time to scale in or double down on your positions. When the VIX pops, especially if it gets into crazy territories like the 50s and the 60s back in the trade war, these are good times to double down when the market is very, very fearful. As the very famous long-term investor Warren Buffett puts it, be fearful when people get greedy and be greedy when people are getting fearful. When the VIX is spiking super high during April's trade wars, eventually it got crushed. So next time if you see a huge spike on the VIX, remember at that time it may look very, very bad, but in hindsight, it may be a good time to actually get some long-term exposure for your swing trades and your long-term investing. But if you're day trading, scalping for 10, 15, 20 points, if you see the VIX elevated, that will be a good time to size down. Let's say normally you trade 10 micros, now's the time to start trading 3. Because if you don't understand that volatility is increasing and you use the same size, you can blow up and not have accounts to trade with before the direction of the market goes towards your bias. Today we traded this market really well. Even though the VIX went up, the market also went up. While I was down earlier in the morning, later in the day I was net green with 8 accounts traded, 7 green and only 1 red. If you want to be part of a community of people that trade day in and day out, we trade together, we bank together, and we pray together, make sure you join us live every day at 9:30. As you can see, there are people locking in payouts like this over and over and over again on Discord. If you want, you can scroll in more. I'm also joining in the payouts that you guys are taking. If you want to be part of this community where we trade together and bank together, make sure you join us at 9:30. If you want my course, go to fspfutures.com that I go into more detail on how I enter and exit trades, trading psychology, how to manage your risk, rotate your accounts properly so that you increase your likelihood of getting a payout with futures prop firms. Make sure you hit that like button and subscribe to the channel, and I'll see you on live.